Yeah, welcome everyone. In this 9 day series on New Income Tax Act 2025, a very good initiative by CASA Group and under the esteemed leadership of Sumit sir. Very many seminars are being conducted, very many webinars are being conducted on Income Tax 2025. As we are all aware, it is now going to get implemented with effect from 1/4/2026. So everyone is getting prepared. What is special about this series is that it is a compact and a short duration series from highly esteemed speakers, making the subject very easy, very understandable, connecting the dots from what we had just left in 1961 to now 2025. The speakers are making the subject so easy, so easy. They are almost making us remember the new sections also. It is not that we have to make an effort. अरे वो उसका 9 था तो उसका क्या हुआ. So yesterday even Sachin sir was comparing section by section. So we could remember, okay, 7 and 8 has become 7, okay, 9b has become 8, okay, like that. So even the structure is getting formed in our head very easily. No much troubles are required. Today also we have one esteemed speaker. I have the privilege of introducing Anshul sir to you. Anshul sir will be taking the topic of income deemed to accrue or arise in India and business connection in India. Let me tell you all a brief about Anshul sir. Anshul sir has 20 years plus of experience in this transfer pricing, foreign direct investment. He has 13 plus years of experience in Big Four. He strategizes tax and transfer pricing compliances for many big multinational companies. And he has a very good grasp of foreign exchange regulation of India, and he advises clients regarding the investment and repatriation of funds. He is working actively in startup ecosystem. He is co-founder of Startup Bazaar and Invest Catalyst Angel Network. As far as his qualifications are concerned, he is graduate. He is member of ICAI. He is a public speaker and faculty for startup course, certificate course of ICI, and he is also faculty for SPJ University, SPJ IMR University. I want to, this is the formal introduction, but if I introduce Anshul sir to you, to the esteemed gathered audience, I had the opportunity of listening to sir in this startup course conducted by ICI, and he was detailing to us the pricing strategies which an entrepreneur should adopt. The pricing strategies that he explained were so intricate and so detailed, also in a short span of time, that till today, even when I have to ask for any amount from my client, I refer to my book, which Anshul sir explained how to go about pricing your product. So, as a chartered accountant, in practice, we are all businessmen, we are all entrepreneurs. So, that course really helped me gather more insight into how to price my product. And it was done in such a detailed plus easy manner that his deliberation is still with me, and I use it in my course of my service. So that's a short about Anshul sir. I'm sure today's topic sir will take in another fashion, and it will stick to us like it will stay evergreen, and it will be as useful as the course that I attended with him, at the opportunity to attend with him. So over to Anshul sir, over to Sumit sir for the intro remark, and then over to Anshul sir. See, we heartily welcome you to the webinar, and we are expecting, not expecting, we are confident that it will be a master blaster session today.
Thank
Thank
you,
you. Thanks a lot.
Shruti. Thank you, Shruti. Thanks to all participants. A warm welcome to each one of you for this showing this faith and joining regularly. This is the third day, and a special thanks to speakers, especially today's speaker, C. Anshul ji, my good friend. He's not only good, he's the best in the international taxation I have heard. सो आई जैसा कि श्रुति ने बताया कि आई एम वेरी मच कॉन्फिडेंट कि टुडे सेशन इज गोइंग टू बी वंडरफुल सेशन एज what were the previous and what is the present law says all about in this international taxation. And thanks to all participants who are joining in this series. And if it is there anything you want to communicate, you can uh, text me, call me anytime regarding this. And this is the text Navratra as said by the Sachin Sinha. And this is the third day. And definitely we are going to learn, we will learn a good knowledge of the income tax. And gradually after this implementation on 1st April, we will try to plan another series with the forms implementation. But in this series also, we are going to learn definitely a good about the law. So with this, thank you very much. And now I straight away request Anshul sir to take up the technical session. Over to you, sir.
Thank you, sir. Thank you so much. And thank you, Shruti, for a very detailed and elaborate introduction. And I'm happy to know that you were part of the Startup India startup course of ICI. And it's good to know, it heartens me to learn that those sessions have left an impact on you. It is an encouragement. It's highly encouraging. Then thank you, Sumit ji, for keeping on organizing these kind of programs and sessions for the yeah, for the fraternity at large. It helps a lot. और आपने ना बार बहुत हाई सेट कर दिया है मेरे लिए क्योंकि then I'll try to meet that expectation. Thank you so much. Let me just share my screen. Hope my screen is visible.
यस परफेक्ट सर यहाँ पर
एक
पैसे रखे हुए हैं सर डायरेक्ट आपने पैसे डिस्प्ले कर
एक मिनट दीजिएगा मेरे को दोबारा मैं करता हूँ 1 मिनट के लिए सॉरी
इन द मीन टाइम अंशुल जी दोबारा ज्वाइन कर रहे हैं मैं सभी को कहना चाहूंगा कि कोई अभी बात चल रही थी 9 डेज की कैसे प्लान करी तो ये 9 डेज की प्लान करने में ही कहीं ना कहीं हमारे सारे टॉपिक कंप्लीट हो गए और इससे कम करना पॉसिबल नहीं हो रहा था सो वी हैव प्लान दिस 9 डेज एंड आई होप आप सभी लोग ज्वाइन करेंगे और 9 डेज एंड सर आ गए वापस ओवर टू यू सर
मेरी स्क्रीन विजिबल है
यस परफेक्ट सर परफेक्ट
ठीक है ओके ठीक है जी तो मेरा आज का काम थोड़ा सा आसान है क्योंकि सेक्शन 9 जो कि इनकम टैक्स एक्ट में है पुराने वाले में और नए वाले में दोनों का नंबर सेम है
गुड
तो, तो हमें नंबर को याद करने की कोई जरूरत नहीं है नंबर वही है सेक्शन 9 जो कि पुराने में होता था सो लेट्स गेट ऑन कि क्या है बेसिकली प्रॉब्लम्स क्या थी अभी उन्होंने क्या सॉल्व किया है थोड़ा सा वो डिस्कस करेंगे देन हम बेसिक कंपैरिजन देखेंगे कि कौन सा सेक्शन वाइज किस तरह की क्लॉजेज हैं क्लॉजेज डिफरेंट कर दिए उन्होंने कि किस तरीके से उन्होंने क्लॉजेज को रखा है and then we will go and take a little deep dive into the provisions of the Income Tax Act 2025 which are broadly similar to the previous one बट उनका स्ट्रक्चरिंग डिफरेंट है कैसे उनको स्ट्रक्चर किया गया है क्या उसमें थोड़ा बहुत नई चीज की है उन्होंने वो हम थोड़ा सा उसको अंडरस्टैंड करेंगे और बेसिक कॉन्सेप्ट्स को भी समझ लेंगे ताकि 1961 में जो कॉन्सेप्ट्स थे अगर उसमें भी कहीं कुछ हमें डाउट्स हैं तो उसके ऊपर भी हम क्लैरिटी ले सकते हैं सो बेसिकली व्हाट वाज द प्रॉब्लम इन द ओल्ड लॉ कि वो बहुत सारी अमेंडमेंट्स थी पुराना 1961 में लिखा गया था फिर वो धीरे धीरे इवॉल्व हुआ बहुत सारी एक्सप्लेनेशंस आ गई बहुत सारे प्रोवाइजोस आ गए तो उसमें इतनी सारी चीजें आ गई कि लोगों को समझने में बड़ी प्रॉब्लम होती थी इवन प्रोफेशनल्स यूज टू फाइंड इट डिफिकल्ट टू अंडरस्टैंड द लॉ के एक प्रोविजन है फिर उसके बाद कोई एक्सप्लेनेशन है फिर उसके बाद एक प्रोविजन है फिर वो कहीं और किसी को चीज को रेफर करता है So there was complex drafting with cross references, retrospective clarifications. If you would remember, वोडाफोन का केस आया था, इनडायरेक्ट ट्रांसफर ऑफ एसेट्स की बात हुई थी, उसके लिए एक नया प्रोविजन डाल दिया, फिर कंप्यूटर सॉफ्टवेयर पे लिटिगेशन हुई, उसके लिए नई एक्सप्लेनेशंस डाल दी, फिर वो सैटेलाइट के थ्रू जो ट्रांसमिशन होती हैं उसको इंडिया ने बोला कि हम इसको भी टैक्स करेंगे, उसके लिए एक नई डेफिनेशन डाल दी, फिर वो सीक्रेट प्रोसेस क्या होता है उसको डिफाइन कर दिया। ठीक है, तो ऐसी बहुत सारी चीजों को ना वो कम्बरसम हो गया था एकदम, तो हैवी एक्सप्लेनेशन था, बहुत सारी चीजें थी। उन सब चीजों को अब इन्होंने स्ट्रीमलाइन कर दिया। वो जितने प्रोविजंस थे, प्रोवाइजोस थे, एक्सप्लेनेशन थे, उनको सबको इन्होंने सबसेक्शन के फॉर्मेट में बड़ा स्ट्रीमलाइन करके सिक्वेंशियली डाल दिया, सो दैट इट इज इजी टू रीड एंड इट इज इजी टू अंडरस्टैंड। सो पैचवर्क था बेसिकली पहले। पैचवर्क क्यों था? क्योंकि वो धीरे 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 अमेंड हो रही थी, जैसे जैसे लॉज आ रहे थे, जैसे जैसे लिटिगेशन हो रही थी, जैसे जैसे गवर्नमेंट को समझ में आ रही थी, वैसे वैसे वो चीजों को अमेंड कर दे रहे थे। बट अब क्योंकि कॉन्सेप्चुअल क्लैरिटी पहले से ही है, उनको पता है कैसे करना था, तो जो नया एक्ट बनाया गया है उसको बिल्कुल स्ट्रीमलाइन तरीके से, क्लियर लैंग्वेज में, विद स्ट्रिक्टर एंड मोर डिफाइंड थिंग्स उसके साथ उन्होंने बनाया है। अब सेकेंडली उन्होंने बिजनेस कनेक्शन और इकोनॉमिक नेक्सस को भी अच्छे से डिफाइन कर दिया। पहले बिजनेस कनेक्शन काफी ब्रॉडली डिफाइंड था, डिफरेंट प्रोवाइजोस में, डिफरेंट सेक्शंस में, क्लॉजेस में डिफाइंड था। सिग्निफिकेंट इकोनॉमिक प्रेजेंस जब उन्होंने लेकर के आए तो वो एक एक्सप्लेनेशन के थ्रू लेकर के आए, उसको ऐड कर दिया। एक डिपेंडेंट एजेंट पी वाला कॉन्सेप्ट था, प्रिडोमिनेंटली स्टार्टिंग में सिर्फ वही दिखता था कि बिजनेस कनेक्शन सिर्फ उसी से हो सकता है। तो इस तरीके के जो कई सारी चीजें थी वो अलग अलग जगह पे थी। सेक्शन 9 ही था, लेकिन क्लॉजेस बहुत डिफरेंट प्लेसेस पे प्लेस्ड थी। फिर कुछ कुछ
सर,
चीजें प्रोवाइजो से डिस्कस हो रही थी।
एक बार अगर थोड़ा सा ज्यादा इंग्लिश और कम हिंदी में करें तो।
अच्छा, डू वी हैव
अक्रॉस
पीपल फ्रॉम
इंडिया,
साउथ इंडिया? ओके,
या, सो,
no issues, no issues, understood,
ओके,
understood. I'll
या।
do that. Thank you so much. So now what is happening is basically there was a lot of detailed or lot of patchy work in the definition of business connection also. We had separate explanations inserted for significant economic presence, digital transactions, user-based transaction, which is basically part of the significant economic presence only. Then how it has to be taxed, what is the attribution criteria. All these were provided in either explanations or provisos. Whereas in the new Income Tax Act, this is all streamlined in one subsection, two subsections, and then it is effectively connected with the other ones. So it is easy to refer to the previous provisions where it is being referred, and the definitions have been made quite easy to read, right? And as I mentioned again, that all these concepts have evolved over a period of time, because these were a reactive kind of amendments. Why reactive? That there is something happening on the broader front, whether it may be a litigation outcome of certain case law, or it is BEPS action plans which are taking place, or there is some recommendation placed in there, and that has to be adopted in the Income Tax Act. And how did they do it? They did it through inserting explanations and explanations and explanation, rather than providing a specific clause, or rather than inserting into the definition of business connection itself. How they were providing it, that it will be deemed to be including significant economic presence, or significant economic presence shall be deemed to be a business connection in India. So there were a lot of deeming fictions being put into the place, which were making the law very confusing, and it gave a lot of scope for litigation and interpretational issues. Whereas in the 2025 Act, the interpretation has been very, the language is very streamlined, structured, which gives a very little chance of interpretational issues or deriving some other interpretation as is written in the law. So that is where the concept of 2025 Act is much better as compared to the language and concept as provided in 1961 Act. So basically, what it means is also that 2025 Act normalizes digital taxation principles, rather than treating them as exceptional expansions. So what it was is that there was a base section of business connection, and then there were expansions to the concept of business connection through explanations or provisos. So now it has been made part of the direct subsections or the definition of business connection itself. So therefore, it does not seem like it is a reactive kind of amendment or something which is derived by external forces. It is now basically part of the Income Tax Act in a normal format itself. Then how the treatment of royalty and fee for technical services, again, there were clarifications, there were a retrospective amendment specifically in terms of how to treat royalty, computer software royalty, then your process definition, then how it is to be treated as, whether it is taxable in India or not. All these things were again provided in explanations and provisos. Whereas in 2025, very clear source-based taxation. In clear terms, it is defined, reducing the dependence on artificial legal fictions, and actually, which were part of basically a responsive and reactive amendments made in the act as a consequence of certain case laws or judicial outcomes which had decided the case in favor of the assessees against the department. I'll give you an example that this was royalty in the satellite case. It was mentioned in the satellite case that wherever the satellite is situated, when the transmission from a channel is delivered to the satellite and then it is transmitted to the TV sets of customers. Indian income tax authorities were saying that this process is liable to tax in India because the satellite operator has provided the equipment or the process for use to Indian channel operator. So they were saying that the fee which the channel operator is paying to the satellite company for using the transmission process, this is something which is a royalty or a fee for technical service in India. Now, the satellite operator, which was a foreign party at that point of time, most of the time it was a Hong Kong based or Singapore based companies which were operating these satellites. They said that there was a provision called there's that process should be secret. They said that first of all, it is not a process because this is something which we are doing at our own end. This is a standardized service which we are providing. This is not a right to use the process which we are providing to the channel operators. We are not disclosing the process to them. It is secret. Then it is a standard service which we are providing. So therefore, they were able to win the case before the Indian judiciary and said, wherein it was decided that this is not neither a royalty, nor a fee for technical services. Now, in the new act, they have made a mention that it does not matter whether the process is secret or not, and they have specifically mentioned that the satellite services are going to be taxable in India. Now, there's another case that whether these operators can still take a benefit under the DTAA or not, right? However, in the Income Tax Act, they have made it as broad as it is possible. So we'll go through the language of the act also. I put in the exact languages of the section, and we'll go through that. I'm just giving you a background, setting the context. Then there is more cohesive uh, or a structured definition of indirect transfer, wherein it has been placed in the subsection itself. The entire definition is provided in one subsection itself. And then there is also a provision which takes care of multiple layers in the indirect transfer. Right? There can be multiple layers in the indirect transfer that company A in country A holds company B in country B, and then that company B holds another company in country C, and then country C holds India. So there are multiple layers. Now, company A, if sells company B may not have directly assets situated in India. It has shares of company C, right? Which is not a company situated in India. So it also, the new act also takes care of such kind of indirect transfers which have multiple layers. I'll show how the language has been, shifted and how it takes care of all these things in a very structured way. So the structure reflects stabilization of indirect transfer regime, shifting from reactive legislation to permanent design. Basically, again, the same thing. So it now formalizes and makes the indirect transfer a very permanent part of the Indian legislative system, rather than just a mere explanation or kind of a separate provision which was incorporated in the earlier law. And as we all know that this was a retrospective amendment which was made uh, after the Vodafone case, which was decided by the Supreme Court in favor of the SSC, and they overturned this case law, this judgment, by retrospective amendment. So in 2025 Act, this is not required to be retrospective because ultimately this is a new act applicable from 1st of April 2025, 2026 itself. So there is nothing required to be mentioned about the retrospectivity. The retrospectivity will still be taken care of by the 1961 Act itself. Right? Understood? So please feel free to ask me any questions if you have as of now. Raise hands or anything if you wish to. Now, there was a lot of use of deeming fictions in the old income tax law. There was extensive reliance on deeming fictions, retrospective clarifications, artificial extension of source rules, and all those things. Now it is not there. The deeming retained but embedded in principle-driven framework and reduced legislative dependence on retrospective correction. Again, because this is a new act, this does not require retrospective amendments to be mentioned here. There are certain transition provisions which are provided in the Income Tax Act 2025. The predominant things which are pertaining to the old law will be taken care by the transition laws, but because this is a new law effective from 1st of April 2026, there is no requirement of mentioning retrospectivity. Now, probably if there is any shift in the view later on, probably we may see some retrospective amendment later on. But as of now, to start with, there is no such kind of clutter in the Income Tax Act. And then there is legal shift from legal fiction dominance to economic connection doctrine, which now is basically formalized and normalized in the income tax law. Then there is an alignment of law with the international tax standards, wherein earlier they were gradual and you know staggered amendments to the law, to the definitions or insertions of explanations, again in reactive and amendment driven format. But now it normalizes the BEP sections in the Income Tax Act structure itself, because basically the significant economic presence is an outcome of the BEP section plans, which takes care of the digital economy taxation. However, we will discuss how the digital economic uh, outcomes or the action plan of BEPS have been elaborated and extended to a lot greater extent in the Income Tax Act, which was there in the 1961 also and has been retained in the 2025 Act also. So now this is it says that means it's consistent with the global standards, but with a lot of extension and a lot of greater coverage as compared to what was planned and what was provided in the BEP section plan. So BEP section plan was limited to digital presence or the companies which were there in digital format. However, the significant economic presence provisions which were provided in the old law as well as in the new law, it extends beyond the companies who are operating in the digital space. It covers companies which are operating in the physical goods or normal delivery of services also. And it also tries to cover, or indirectly it covers, as of now the language is so broad that it covers companies who are taking services from India also. So not just companies providing services, but companies who are taking services. I'll explain how the language covers that. But let me just finish off the basic concepts. So litigation and risk and interpretational certainty is much more higher in the new law, because the language is much more streamlined, structured, whereas in the old law, there were a lot of cross connections, there were explanations, then the retrospectivity, then there were questions about the retrospectivity before the judiciary also. Then there were a lot of different interpretation as to, okay, if you are assessing the company itself who had entered into the transaction, then there will be, or who is liable to pay tax, then there will be some other interpretation. And then there were a lot of implications on the in the Indian company which was transacting with the foreign company. Say, for example, if I had purchased shares of a shares from a foreign company, which probably could have triggered an indirect transfer. Right? In those scenarios, withholding tax provisions would also get applicable on me as a buyer under Section 195 in the old law. But because of the retrospectivity of the amendment, if the transaction had happened prior to 2012, then there were case laws, there have been judicial precedents which say that although the retrospective amendment will be applicable on the taxpayer itself, but not on the person who was liable to withhold tax, because at the time of the transaction, there was no clarity that how to withhold tax. You have made a retrospective amendment, so the buyer will not be able to implement that as on date. So even though the taxpayer who had actually earned the profit was liable to pay taxes, but it was not applicable on the payer. But now, because in the 2025 Act, it is part of the basic law itself. So going forward, and as of now, also when the retrospective amendment had been made, withholding tax provisions will also apply accordingly on the buyer or the payer for these kind of transactions. So this is how the interpretation certainty will be there. The litigation risk as of now, till there are no other amendments or no other insertions in form of explanations or provisos, the legal certainty and interpretational certainty is going to be there. But considering the very innovative minds of Indian professionals, I'm pretty sure that they will find out certain loopholes or certain areas where they will try to litigate in the new law itself also. But as of now, it seems a little bit remote. Now, policy orientation, it's more proactive, system design framework, focus on economic participation, territorial nexus. They are very clear on what is going to be taxed in India, what is not going to be taxed in India. So, a very clear kind of language has been provided, and it leaves lesser scope of interpretational issues. So, the policy is very, very clear that if something is driven or sourced from India, and even if remotely attributable to India, it should be taxed. Although some kind of exemptions have been given, say for example, in the salaries, the the short stay exemption still remains, right? In terms of royalty and fee for technical services, if those have been utilized outside of India for a business carried outside of India, these kind of exemptions will still remain. However, predominantly the structural design or the concepts of the old law have not undergone a lot of change in the new income tax act. Let's get into the some comparison. Basically, this is a comparative table of the old new income tax act and the old income tax act. So there were a lot of clauses. If you would find that most of the definitions were provided in subsection 1 itself, wherein a lot of clauses were there. However, in the new income tax act, which is the 2025 act, each definition has been provided in a different subsection. However, a good part is that dividend, interest, royalty, and fee for technical services, which are the most used kind of definitions, they have tried to retain at least the clauses. Means it was clause 4 in old act of subsection 5. Now it is subsection 4. So at least this is a simpler thing. The dividend section 9 subsection 4, earlier it was 914. So it just replaces 1 in between, and it's just 94959697, right? 94959697. So at least these four are easy to remember. Also, the sum given by non-resident to NR, this was also similar. Business connection and significant economic presence. This is different because business connection earlier was defined in subsection 1 itself, whereas now it is part of subsection 9. Then capital assets and indirect transfer, it is subsection 10, whereas it was earlier subsection 1 itself, but read with explanations 5, 6, 7. And in business connection, it was explanation 2, 2A, 3, 3A. A lot of other things that there were provisos also in this particular thing. So all have been streamlined into subsection 9 itself. So 9 has these many clauses A to G, and similarly 10 has different clauses A to G. But ultimately, in one subsection, easy to read, very streamlined kind of a structure which has been provided in the Income Tax Act 2025. Then there is income of non-resident taxable irrespective of presence. Again, it was provided in an explanation under the old law. Now it is part of a subsection. It is a separate subsection 11, which says that non-resident, the above incomes of the non-resident are taxable in India, whether or not they have a presence in India or not. So very, very similar kind of definition, but in a subsection format. Then there are certain fund managers who are excluded from the definition of business connection, which was provided in a separate section itself in the old law. Now it forms part of section 9 itself, subsection 12, and meaning of through, because the definition of business connection consists of a term called through. We'll read out how that through was also defined again in explanation 4. Now this through has been defined in a subsection, but the definition remains the same. So there is no change in the definition, but there is a change in the structure, how it is placed in the section. Now let's get on to the law itself, that how the structure of section 9 is in the new Income Tax Act. First of all, it says income, and let us first understand why section 9 is important. Section 9 is important for the taxability of non-residents. Why? Because non-residents are generally taxed in India as per section 5 for incomes which accrue or arise in India, or deemed to accrue or arise in India. So now this section 9 provides the incomes which shall be accruing or arising in India, or which shall be deemed to accrue or arise in India. So all these incomes, if earned by non-resident, will be treated as taxable in India. And once these are taxable in India, first non-resident will have to pay taxes as per various provisions, like in the old law 115A was there that defines the tax rate, and also puts an obligation on the payer of these remunerations or the considerations to withhold tax in India as per the provisions of the Indian Income Tax Act. So there are dual responsibilities. One, at the time of the transaction where the payer has to withhold tax, and at the later point of time, if the tax is not the full amount, TDS is not the full amount, then they pay the balance amount by the non-resident, or at least consider that income as well as the TDS and file the income tax return in India. Obviously, this section is subject to the provisions of the double taxation avoidance agreement, wherein if the provisions of double taxation avoidance agreement are better or beneficial for the taxpayer, those can still be availed, provided the documentation of tax residency certificate or the declaration of the prescribed particulars in Form 10F and the new corresponding form in the new law is filed, and also a new no P certificate is generally provided. No P certificate is not provided in the law, but it is a general practice so as to safeguard the triggering of higher tax in respect of permanent establishment, which is 35% generally, as compared to the lower tax of royalties or FTS, which is provided in the income tax law as well as in the treaty. So that is a generic safeguard which we take, not provided in the law itself. Whereas the TRC and Form 10F and the corresponding form are provided in the law itself. Right? So just a brief background as to why Section 9 is important. Now, Section 9 starts with subsection 1, which says income deemed to accrue or arise in India shall be the incomes which are provided in 228. So it says these incomes which are provided in 228 shall be deemed to accrue or arise in India. Right? Now, what is subsection 2? Any income accruing or arising directly or indirectly through or from any asset or source of income in India, any property, any business connection or transfer of asset situated in India. Now, if you would see that this is, as of now, a very clear-cut, pointed definition, whereas earlier it was provided in one sentence itself. It was followed by commas, 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 and in uh, one sentence itself. So many times people were not uh, uh, able to interpret whether the through or from will apply to any asset or any property. Now all of these, income accruing or arising directly or indirectly, through or from, shall apply to all these 4 points. So there is no confusion as of now, right? And any asset means any asset, be it immovable property, be it shares, be it any source of income, any property, any business connection. Now, business connection is defined later on. How and it is still an inclusive definition provided in subsection 9, but business connection is provided here. Then transfer of a capital asset situated here. Now, any income through or from any asset. Now, this asset may not be transferred, but it may lead to generation of certain income. Say, for example, there is an asset which is giving you a rent, or there is an investment in mutual funds which is giving you a dividend, or there is an investment in say, for example, some bonds which is giving you interest, or bank accounts which are giving you interest. So these are assets, FDs and all those things, but ultimately it's giving you an income. So all those incomes from any asset or source of income in India. And now source of income can be gift also, that you are receiving a gift from an Indian person into your bank account, or a property is gifted to you. Now that is a source of income in India. So these are kind of incomes which are all going to be deemed to accrue or arise in India, right? So this is directly or indirectly, through or from any asset, source or income in India, any property in India. This is this. Now subsection 13 in subsection 2, section, the expression through shall mean, this is a typo. It's not in subsection 2. It's subsection 9(13) itself. The expression through shall mean and include by means of, in consequence of, or by reason of. So this is exactly the same definition which was in the earlier law, but now it's provided in a separate subsection itself. By means of means by means of asset, in consequence of transfer, basically by reason of any property or by reason of any business connection. So through means any of these, correct? Then subsection 9 says any income falling under the head. Now, this is subsection 2 is the broader concept, that what all is included here. Then from subsection 3 onwards, it starts with the specific heads of income, that what are the different heads of income which are going to be covered here. Then it first is salaries. Any income falling under the head salary shall be deemed to accrue or arise in India if earned in India, and any income payable for services rendered in India, and the rest period or leave period which is preceded and succeeded by services rendered in India and forms part of the service contract of the employment, and shall be regarded as income earned in India. So this is also streamlined. Earlier, there were certain interpretational issues wherein uh, the interpretation was taken that even if services are rendered in India, it may not lead to taxation, or how to see the rest period. But now it is very structured and provided in a subsection itself, and also payable by government to an Indian citizen for services rendered outside of India. So why does it mean? What does it mean that people who are in the embassies located outside of India but are on the payroll of Indian government, all these salaries are going to be taxable in India, and only to the Indian citizen. So not to the staff, the local staff which is hired there in those jurisdiction, not that staff. But if Indian citizen means a person who is generally deputed from India to those embassies, because if you would see, those incomes, these salaries incomes are not taxed in the local jurisdiction, right? In the UN conventions, uh, the income of Indian persons working in Indian embassies outside of India is not generally taxed by that jurisdiction. So there will be certain taxability where it will be with the Indian government because it is an Indian embassy. So that is provided in the Income Tax Act. Generally, similar kind of provisions are also there in the double taxation avoidance agreements also. So there is generally no dispute on these kind of incomes. Now, then it says dividend paid by an Indian company outside of India. This is very much similar dividend paid by an Indian company outside India. So this is in India, if it is paid within India, then it is always taxable. Means there is no deeming fiction required there. So you don't feel that dividend paid by an Indian company in India gets out of the taxability. So paid in India, then what will it trigger in section 5? It is received in India itself. So there is no requirement of deeming fiction. So if a non-resident has an income tax, has a bank account in India and receives the dividend income within India, then in those circumstances, deeming fiction itself is not required because the non-resident has received that income within India, so it is again taxable in India. Why? Because in section 5, there are two kinds of income which are taxable. One, three kind. Accrue or arise in India, deemed to accrue or arise in India, and third part is received in India. So when you have a bank account in India, so that means if the dividend is paid within India, then there is no requirement to make it as deemed to accrue or arise in India. Right? So dividend paid by an Indian company outside India, it is to be treated as deemed to accrue or arise in India. And it is obviously when it becomes deemed to accrue or arise, it becomes taxable. Then we get into interest. Subsection 5A defines what is income by way of interest. It says that interest is payable by the government. First, in any kind of circumstances, if interest is payable by the government, it is going to be taxed in India. What is government? Say, for example, in our parlance, the interest on income tax refunds. This is an interest paid by government, right? So any interest paid by government of India on income tax refund. This is a very generic example which we can relate to in our normal parlance is taxable in India. And now many times it may happen that the income tax refund may not be treated as debt incurred to the government because it's not a debt which you have given to government. It's some extra amount which is remaining with them as tax. So tax is generally not a debt if we are going to interpret it in that way. So if any kind of interest is payable by government, that is taxable in India, deemed to accrue or rise. Second is a resident except where it is payable in respect of any debt incurred, except where it is payable in respect of any debt incurred or money borrowed or used for the purposes of. Means first condition, if an interest is paid by a resident, it is going to be deemed to accrue or arise in India. Right? Now, what means if I am a resident, I have taken a loan and I am making a payment to a non-resident person, then it will be first of all deemed to accrue or arise in India. Now, what can be the other circumstances? If I am a company, I have a permanent establishment or a branch situated outside of India, say for example in Sri Lanka for executing a project, infrastructure project. Now, in that infrastructure project, I have taken a loan in the local bank itself from a local person in Sri Lanka. And that loan is being utilized for that project, which is being carried out in Sri Lanka only. In those circumstances, it says that now, because that branch is my permanent establishment, that is not a separate legal entity. That project office is my own extension, virtual extension. So it is me who am paying. If this definition would apply, I will have to deduct a TDS in India for a loan which is taken outside of India and utilized outside of India itself. In those circumstances, an exception has been provided and it was there in the old law also that except where it is payable in respect of any debt incurred or money is borrowed and used for purposes of business or profession carried on by such resident outside India or making or earning of any income by such resident from any source outside of India. Now, this is a broader thing. There are certain litigation also here, but because they have retained the language as such, so it remains. And now the litigation, what kind of litigation it's there is, say, for example, you are in the business of export of goods and you have taken a LLC or taken a discount, and you have discounted your bills. Now, in those circumstances, certain interest payments might be required to be paid, but you are earning income from any source outside of India. So, if you have taken an LC or you have discounted the bills from a foreign lender, in those circumstances, if you are making a payment of interest, then whether this is covered by exclusion in this particular clause or not, this is subject to interpretation and litigation. And as of now, there is no conclusive argument or conclusive decision by the Indian judiciary in this respect. However, as of now, generally on a conservative basis, if any interest income is being paid, most of the Indian residents generally deduct TDS in India. Then this was a payable by resident. Now, when a resident was paying the interest, first condition was that it is chargeable to tax in India, except these two conditions. In non-resident case, when a non-resident is paying an interest, so first thought will be that there is a non-resident who has taken a loan, there is no nexus with India. So I think someone is scribbling on the screen. I'll request. Uh, I'm not very sure whether somebody else is also seeing the scribbles. So in a case of non-resident, the first and foremost thought is that the non-resident taking a loan outside of India, paying the interest to a non-resident also, it is not taxable. However, in certain circumstances, which is a reverse case scenario for the resident, that resident was utilizing the loan outside of India for a project there. Similarly, in case of a non-resident having a permanent establishment or a branch or a project office in India, taking a loan for that project office which is situated in India and utilizing those funds in India, if in those respect any kind of interest is being paid, then that interest becomes taxable and deemed to accrue or arise in India, right? And why? Because there is a specific nexus with the Indian income tax, Indian jurisdiction, that fund or that debt has been utilized. So how it is written? A non-resident income by way of interest payable by a non-resident if it is in respect of any debt incurred or monies borrowed and used for the purposes of business profession carried on by such non-resident in India. So this is very clear. So interest is now clear that how the definition plays out. It is almost identical to the old law itself. For the purposes of Clause A, any interest payable by a permanent establishment in India of a non-resident person engaged in the business of banking to a head office or any in this thing, generally the payment is being made to a third party. However, in a banking situation, what happens is that most of these foreign companies, the HSBCs and the Standard Chartered, generally Standard Chartered banks and all these foreign banks predominantly operates under a branch structure only. They don't open up a subsidiary or separate legal entities for conducting their banking operations. So in those situations, the permanent establishment in India may take loan either from the head office or from another branch operating in another country. In those situations, they may pay certain interest income. In those kind of situations, it is said that interest payable by PE in India of a non-resident person engaged in banking to head office or any other PE or any other part of such non-resident outside India shall be deemed to accrue or arise in India and shall be chargeable to tax in India. So if a banking branch of a non-resident company in India has taken a loan from head office or any other permanent establishment operating in another country and is paying interest on that loan, that interest will be taxable in India and shall be deemed to accrue or arise in India. And similarly, it says that any interest payable by a permanent establishment in India of a non-resident person engaged in business of banking to head office or any other such part shall be deemed to and shall be chargeable to tax. I think this is a repetition. This is a repetition. Such permanent establishment in India shall be deemed to be a person separate from and independent. So what it means is that for the purposes of this interest taxability, the permanent establishment shall be deemed as different, because ultimately when when this the what I say, if this financials of the permanent establishment are being created, then on a standalone basis, the return is not filed. Generally, the return is filed for the entire company as a whole. If the head office is earning certain different incomes from India, in those circumstances, there will be one return. But for the purpose of taxation of interest income, it is to be treated as a separate person, independent from the non-resident person of which it is a permanent establishment. And the provisions of this act relating to computation of income, determination of tax, and collection recovery shall apply accordingly. Now, what happens is that if you prepare consolidated accounts, then there will be no interest income, because permanent establishment making a payment of interest income to head office in the consolidated accounts, it will get set off. There will be neither a expense nor an income, right? Because it is one and same entity. But for the purpose of computation of total income, the business income will get reduced by the amount of interest reduction, whereas interest income will get taxed as another income for the parent company, right? So that is how the computational provisions will apply, not the tax filing provision. So there are not going to be two filings of the tax return by permanent establishment and by head office. There will be only one filing, but the computation of income has to be calculated in such a manner that once in the business income you will take a deduction, and on the other side, in interest income from other sources, you will have to include that interest income in that part of the computation. So please don't confuse that. For the separate person, it means that you have to file two tax returns of a permanent establishment and of the foreign parent company. It is just for computation of income provisions, nothing else, right? Permanent establishment shall have the meaning assigned to it in subsection 173C. So permanent establishment is defined therein, which is obviously the same kind of definition which we had, very inclusive definition. Now we come to income by way of royalty. Again, similar kind of language which we had in the earlier law. How does it make? It's similar to what we saw in interest, that payable by government, taxable in India without any exception, whether it is used in India, outside India, uh, any kind of intellectual property, or whatever is defined in royalty. If paid by government, then there is no exception. It is going to be taxed in India. Then by a resident, except where such royalty is payable in respect of any right, property, information used, or services utilized for purposes of business profession carried outside India, making or earning any income by such resident from any source outside India. Again, similar thing, that royalty, first foremost principle, if payable by resident, taxable in India. However, if that resident is utilizing those intellectual property rights or anything pertaining to royalty consideration, any right or asset or property for which royalty is being paid, if that asset, property, or any right is being used outside of India for a business or profession carried outside of India, then it's not going to be deemed to accrue or arise in India, or for making or earning any income from such by such resident from any source outside of India. Now there are from any source outside of India has been interpreted differently by judiciary. I'll just give you an example. There is one case law, I think of Havels, which says that the company took a plea that if we are exporting goods outside of India, that means that we have a source outside of India. In that case, the judiciary held that no, your source is within India because your manufacturing is in India, your sales team is in India, your everything is in India, just your customer is sitting outside of India. So that does not mean that there is a source sitting outside of India. Your actual business is in India, and that is what makes your source of income, not just the customer. Whereas in a few other cases, it has been held that a customer situated outside of India is actually the source of income. And if you would see that this is also the position of India, wherein they are saying in web section plans and many other international forums, they have been keeping on saying that because India is a marketplace for the foreign companies, that makes the India as a source country for the incomes earned by the digital companies. That is the basic premise where the Indian government has been pitching forward to get some taxation rights on the digital economy or the digital transactions which are happening over internet, and for which there is no presence of the foreign company in India. So India has always been taking a position that just because the customer is situated in India, they get the right to tax because this customer creates a source in India. Similarly, in a reciprocating manner, if a customer is situated outside of India, then that becomes a source outside of India. However, this argument has not been pressed as of now very uh, significantly by the taxpayers, but we have seen generally this argument is generally not taken, right? So probably this is worth exploring in future. Maybe certain SSCs will try to take this position because it matters a lot. Because if you are a manufacturing company which is predominantly engaged in export of goods, and you have taken a technology, you have entered into a technological collaboration agreement with a foreign party. In those circumstances, you may try to take a plea that this income is from a source outside of India, and therefore any royalty which I am paying for the technical collaboration shall not be deemed to accrue or arise in India because I am making or earning income from a source outside of India. So this is only a food for thought. Not There is no conclusive argument on either side as of now.
So there's one question relating to royalty.
Yeah.
In the new act, human intervention controversy is still there as technical service. Please, once again, summary of royalty in terms of process as secret and what is now the conclusion in the new act. So, human intervention, whether that controversy is still there.
The human intervention generally is part of fee for technical services, not generally of royalty, because technical services are such which are being provided either through machines or through humans also. And it was in terms of fee for technical services that it was mentioned by judiciary that because these the definition says managerial, technical, or consultancy services. While reading these terms, the judiciary interpreted that these are managerial, technical, or consultancy services can be provided by humans only. These can't be provided. Managerial, technical, or consultancy services cannot be provided by machines only. There has to be certain human intervention in between, right? So now it says including provision of services by technical or other personnel. Until means in the new law itself also it talks about other personnel only. Now it does not include construction or this is this. So the human intervention thing as of now, there is no clarification in the in the new law it's also because there is no amendment which was provided in the old income tax law also. So government has not disputed this that there is no human intervention required. So they have accepted that position from the judiciary. They have not countered it. These kind of laws which were there in the case of Bharti, Airtel, or Vodafone, BSNL, most of the times it was in the generally case of telecom services or the satellite services which was there. And in most of the cases, the judiciary took a position that human intervention is required. Now, what as a counterpoint the department tried to do was that they tried to prove that there is no human intervention. So there is an human intervention involved. Ultimately, they tried to argue. They conducted detailed interviews. They form part of the judgments in cases of Bharti and all. They conducted a detailed interview of various persons involved in the processes and try to formulate a view that no, there is actually certain human involvement. They are writing codes, they are managing the machinery. If there is any bug, they will remove that. So by that way, they try to prove that yes, there is some human intervention involved, but ultimately they didn't contravene the basic judicial premise that there is a human intervention involved. And they did not make any kind of amendment in the old law also. So therefore, that concept which has been provided by the judiciary that human intervention is mandatorily required, that now formulates part of the law itself. So that is an interpretation which is accepted by the government as well as the SSC. Now the question which comes is whether on the factual aspect, whether there is a human intervention or not. That cannot be formed part of law. That has to be proved on the basis of facts and evidences only. Right. So therefore, there is no amendment required in the new law or no clarification required in the new law itself. Hope I have made
Okay.
it clear. Right.
Yes, yes. Sir, also royalty, you were explaining that like the transmission which is happening in India for a person who is providing services from outside India in terms
Right.
of royalty. So there is a process and the process is secret, and then what is the conclusion in the new act?
Just tell you
So
where
whether
is
it
that.
will be taxed in India or not.
So they have retained the kind of taxability. I'll just see where is it mentioned, whether it is there or not. Just give me a moment. I'll just take a moment to go to the Income Tax Act on the website itself, because for the uh, sake of brevity, probably I might have skipped that provision. Just give me a moment. So this is the definition of royalty, right? So unfortunately, the link on that slide was missing. So this is the definition of royalty. In this subsection, royalty means consideration for the following, which is absolutely the similar kind of definition which was there in the old law: transfer or grant of any rights in respect of patents, invention, model, design, secret formula. Now, the question was always there in terms of secret formula, that what is secret and what is not secret, whether there is a secret formula process. Now, there was a judgment which said that because there is no comma after formula, then the secrecy, that secret term also applies to the process, right? So this was the judgment earlier, that they mentioned that secret means secret formula also and secret process also, because there is no comma here after the formula. Now they have clarified this by saying that expression process includes transmission by satellite, including uplinking, amplification, conversion, for downlinking any signal, cable, optical fiber, or by any other similar technology, whether or not that process is secret. So this was there earlier also. However, this is always subject to the provisions of DTAA. So even though the Income Tax Act provides for these kind of provisions which are explicit, which are kind of very broad in nature, however, because most of these companies operating these satellites are operating through countries which have a DTAA in India, the judiciary has always taken a consistent stand that wherever the uh, Article 12 is defining royalty in those articles, that does not mean that does not take into consideration the secrecy or the process term as defined in the act. So it remains as it is in the in the DTAA, which is narrower as compared to the provisions of the Income Tax Act. And almost in all cases, the judiciary has taken a position that the amendments to the Income Tax Act do not vitiate the provisions of the DTAA, and they remain same. So even though Income Tax Act provides these kind of broader definitions, but uh, not in the DTAA. So we have to be careful only if the satellite company or such kind of a company which is providing us the process is coming from a country which is not having a DTW with India, right?
Right, sir. Thank you.
So this is the definition, which is almost similar. However, what is good part is that all of this has been provided in one subsection itself, 6. Otherwise, all these were in different explanations. Computer software was, I think, in 4 for a process was in some other explanation. So you had to link it. It was not there within the definition itself. So one might have skipped where to read or how to link it. Now it is part of one subsection itself, royalty, subsection 6, right? Now, it also says royalty includes consideration in respect of any right, property, information, whether or not the possession or control of that right, property is with the pair. Now, what does this mean is that many times a position was taken that when a person can transfer what it has. So, if I am not the owner of the property, the intellectual property, or any right which I am further transferring it, then it was mentioned, it was argued that if I am not the owner, how can I transfer it or how can I sublet it? So, by those provisions, the SSEs were trying to take an exception and say that this kind of consideration is not uh, a royalty income. Now, the Income Tax Act has provided very clearly that it does not matter that uh, uh, whether the payer has, in fact, it was also taken that if I am taking a position, means the payer, I'm mistaken. Let me correct myself. So where the payer means I am a payer, Indian payer, I am taking a position or control of the right or property or the information, only then that payment will become royalty. Say, for example, if I am taking cloud services. Now, generally, what the argument was that I am not in control of the cloud server. I am not taking any control. There is no right which has been transferred to me. There is no right in the property, no right in the process or the software or the cloud server. So why it should become a royalty? Because royalty generally, in essence, means that some possession or some right has been transferred to me as a recipient of that service. So here it clarifies that possession or control does not matter whether it has been transferred or not, whether it has been assigned or not. It will not matter for the purposes of royalty. And that right, property, or information is used directly by the payer also does not matter whether I am utilizing it or whether I am paying for somebody else utilizing it. Say, for example, I have some customers for whom I am procuring certain services, for certain royalty services. Certain software is being taken, which is being provided to my customers. Not I'm not directly using it, but I'm making a payment because I'm collecting the payment from some of my customers. In those situations, my argument would have been, see, I'm not even using the services or the right or the property, then why it should become a royalty for me? Because I'm not utilizing it. So if somebody else is utilizing it, but I am paying for it, then also it becomes a royalty income as per the definition provided in the Income Tax Act. Correct? Or the location or the right of property or information is in India. So also the argument was that the servers is located outside of India, the software is located outside of India. Many times the cloud softwares are being provided to the Indian customers. In those circumstances, there is no download which is happening, there is no installation which is happening onto the Indian systems, Indian computer systems. In those circumstances, also the argument was being taken that because there is no download happening, there is no transmission of software which is happening to Indian customers. We are just utilizing the software which is based on a server which is located outside of India. So it does not accrue or arise in India. Those kind of situations have also been taken care of by this particular line, which says that location of that right, property of information is in India, whether or not, right? Whether or not the location of that right, property, or information is in India, it will include, it will get included in the definition of royalty if the base definition is satisfied. If any of these provisions is satisfied, then whether it is located outside of India or in India, whether I have got the right whether there is a transmission or transfer of any right or not, whether I am getting the possession of the right or not, that does not matter. Correct? Whether it is used by me directly or used by somebody else, but if I am paying and if it gets covered in any of these criteria, it is going to be considered as royalty, deemed to accrue or arise in India. Right? Very clear. Now there is one more
Yes, sir.
part here.
So what about DTAA for this clause?
Generally, for DTAA, the royalty still see there is one. This is complicated. This is not so easy. What happens is in the DTAA there are provisions, these basic provisions which say that if there is any term which is not defined in the DTAA, it has to be interpreted as per the domestic laws of the country. Now, there also the income tax authorities try to argue that the process kind of terms or the through kind of terms are not defined in the DDAA. So, therefore, they have to be interpreted as per the Income Tax Act. Now, in those cases, the judiciary held that, see, these are very generic terms. These are not specific terms which have to be defined everywhere. So, if you kind of try to define every through or every process or every kind of term, that does not mean that you have to take an interpretation from the Indian Income Tax Act. And therefore, they disregarded the argument of income tax authorities and held that even though after the amendments you have made in the Income Tax Act, we are not going to take the interpretation and interpose them on the DTAA. So, by taking those clues, probably we can still argue that if we are going to argue in a DTAA kind of a scenario, we may still argue that royalty in general parlance, in general legal and international laws, it is interpreted that generally some possession or right has to be transferred to the payer in order to qualify it as a royalty. So, as of now, I would not say that there are too many judgments around this particular aspect, but yes, this kind of argument can still be taken. Right?
Right, sir.
Okay. So now let's come on to income by way of fee for technical services. By again, it's almost similar to what we have read for royalty paid by government, paid by resident, except exceptions are similar. If FTS is being paid for a business carried on by a resident outside of India or for making any income from source outside of India, it gets excluded. Otherwise, payable by resident means it is deemed to accrue or arise in India. For non-resident, if the payer is a non-resident, payer of FTS is a non-resident, it is the other way around, that if a non-resident is carrying on a business or profession in India or making any income from any source in India, then if in respect of those incomes they are making a payment of fee for technical services, that becomes taxable. Now, let me give you a live example. We are dealing with some foreign companies which are German based and they have some projects in India. Now, even though those projects are not creating a PE of these German clients, right? However, for executing those projects, they are again hiring certain other foreign vendors. Now, those vendors are providing technical services. In that respect, what is happening is that because these projects are being carried out in India, so therefore this source of income is in India. Now, uh, carrying on business or profession in India does not mean that it has to be a taxable business profession. It means that you are doing certain projects in India or making any source, making or earning any income by such non-resident from any source in India. It does not mean that income has to be taxable in India also. It just means that you are earning certain income from an Indian source. So there is no linkage or connection with the taxability of such income. So in those circumstances, what is happening is that the income of the German clients, or it may be any other clients, they are not taxable in India because they are not creating a permanent establishment, right? Probably it may be considered as normal business income. However, in certain circumstances, it may also be considered as fee for technical services because for fee for technical services, there is no time criteria. If the original contractor is providing certain technical services, then that will be taxable as fee for technical services. Now, in those circumstances, when that non-resident is taking services from another non-resident for the same project and making a payment thereof, then that transaction is entirely outside of India. Many a times it may happen that they are just taking some drawings and designs, which the foreign party may not even be aware that it is going to be utilized for a project in India. In those circumstances also, this particular transaction gets taxable as in India, right? A non-resident, if it is payable in respect of services utilized, because those drawings and designs are being utilized for making or earning any income by such non-resident from any source of India. So in those circumstances, that transaction also gets taxable, and most of the times, this transaction also gets taxable in the DTAA. So there is no exclusion for such kind of transactions. So because these are FTAs, because these are until and unless there is a make available provision applicable, then only we can see to it. But in generic countries like Germany, Japan, China, your various other countries, so where make available clause is not there, in those circumstances, this kind of transaction becomes taxable under the DTAA also. Right now, what is the DTAA? What is the definition of fee for technical services? Again, in subsection 7 itself, it's mentioned. Same definition is there. Any consideration for lump sum consideration for rendering of managerial, technical, or consultancy services, but does not include consideration for any construction, assembly, mining, or like project undertaken by recipient. So this is excluded. This was excluded in the old law also, that if the Indian person is undertaking a construction, assembly, mining, or like project, and if these services are being utilized for this particular thing, then it's not going to be taxed as FTS. This is not going to be considered as FTS, or which would be income of recipient chargeable under the head salary. So if he's an employee and that person is providing employment services, rendering technical services in the course of employment, then that income becomes taxable as salary, not as fee for technical services. So fee for technical services means payment made to person who is not an employee of mine. Understood? Very clear. No, I think there is no clarity required here. Then we move on to incomes which are. Acha, one more thing. I think one thing I skipped in royalty. Where is it? The definition of royalty. Let me go to the definition of royalty once more. There is a presumptive taxation which applies to certain kinds of income, wherein if the plant and machinery are provided on hire for prospecting, extraction, or production of mineral oils, then generally the foreign company is taxable on a presumptive basis, wherein 10% of the total revenue is considered as taxable profit in India. And on that amount, generally the normal tax liability of 35% is applied. So what it means is, if the foreign company is earning a revenue of 100, then 10% will be the deemed profit. And on that, your 35% plus surcharge and cess as applicable will be there. So the effective tax liability will be somewhere in the range of 3.9 or more than 3.5 to somewhere around 4.5% of the total revenue of 100. Whereas if it is considered as royalty itself, in first case, then what will be the tax rate? The tax rate will be 10% minimum, as generally in the DTAAs, of the total revenue of 100. Right? So many a times it may be good to go into the presumptive taxation rather than just keeping it in the normal gross basis taxation under the royalty income. So if you are in such kind of a business wherein the plant and machinery is given for prospecting, extraction of mineral or production of mineral oils, then you can go for this presumptive taxation rather than to get taxed under the royalty definition. Because royalty also is overlapping. Royalty also says that right to use any industrial, commercial, or scientific equipment, except the amounts referred to in section 61(2). Now this is section 61(2) is New Income Tax Act 2025, which gives a table of presumptive taxation related to non-resident generally, right? And now then we come to section 9(8), which says income accruing or arising in nature of some refer to section 249U paid by a resident in India to a non-resident not being a company or to a foreign company or a person not ordinarily resident in India under section 630. So what does this mean? 249U, what is this? Anybody who can tell me what is this? Somebody can write in the chats. Anybody who knows what is section 249U? One old 5627, similarly, right? Correct. So what it is it is gift. It is gift which is given by a resident to a non-resident. So what generally earlier was happening that this was most of the times excluded. People who were not non-resident, who were non-residents, were taking gifts from Indian residents in their bank accounts outside of India. So what they were taking a position is that, see, this gift is received by me outside of India, and this is given out of natural love and affection, even though they were not relatives. So if some gift is given to them, probably the definition of relative as per RBI may differ from the definition of relative as per Income Tax Act. So there are a few relations which are different. So under the FEMA law, you may be allowed to give a gift to certain relative, which is not a relative as per the definition of the Income Tax Act. So in those circumstances, the gift given by you, which is compliant with the foreign exchange regulations, may be taken as an argument that this is not accruing or deemed to accrue or arise in India, because this gift has been received by that non-resident or RNOR outside of India, in their bank accounts outside of India. So to clarify that, the Income Tax Act was amended a few years back, which said that if the gift is being given by an Indian resident, then whatever it may be, we will deem to accrue or arise in India. We will deem this gift to accrue or arise in India, whether you have taken it outside of India or you have taken it, received it in your NRO NRE account within India. So this is actually a replication of those provisions in subsection 8, that it says income arising arising outside India. Arising outside of India means the gift has been given outside India. There may be a case that the property is situated outside of India, that an Indian person has a property situated outside of India that is being gifted to a child, say for example, or a daughter-in-law who is based now outside of India. So if you would see that in terms of daughter-in-law, it gets clubbed, or it may not be chargeable to tax. So in those circumstances, probably whatever was not covered under the definition of relative used to get exempt. Now, in this situation, what they are saying is that if it is paid by a resident in India, then we are going to deem it, we are going to consider as deemed to accrue or arise in India. Now, here it mentions to a non-resident, not being a company, or to a foreign company. Now, why does they exclude this? You will find almost everywhere. Whenever a non-resident is being written, it mentions a non-resident, not being a company, or to a foreign company. Why a company is being excluded from non-resident? Why they are saying that a foreign company, specifically a foreign company? Why the company is not just written here in non-resident? This is because a foreign company can become a resident in India. So there can be a foreign company which is based out of India, but it becomes a resident by virtue of a place of effective management. So when a foreign company becomes a resident So you may say, argue that I am not a resident, so this provision does not apply to me. So therefore, a non-resident is always written as if a non-resident not being a company or to a foreign company. So whenever you are making any payment to a foreign company, that will become taxable in those hands, in a foreign company's hand, it will always become taxable because it is a foreign company, whether or not it has become a resident or not. Right. So in the earlier provisions of section 195 of the old law also, whenever you are making a payment to a non-resident, not being a company or to a foreign company, in those situations, section 195 used to apply. Why? Because whenever you are making a payment to a foreign company, even though it may become resident because of their place of effective management in India, then you would say that this has become a resident, so section 195 does not apply. Section 194J or 194C should apply. So it was not the case. You will have to still apply section 195 because this has been excluded from the definition of non-resident. Means they are not considering non-resident to be a company. They are just saying that if we are making a payment to a foreign company, we are going to apply section 195 and similarly correspondingly in the new act also. So just mentioning why this is mentioned for the purposes of this section business connection. Now the very important section of business connection comes at the fag end of the section, which is 9.
Sir, just pausing for a minute. What would be the withholding tax rate in this case?
Withholding tax rate will be the normal tax rate of gift, other income.
Okay.
Whatever, if you are giving it to an individual, the slab rates will apply. Most of the time, the maximum marginal tax rate you will apply. In the terms, if you are giving it to a company, the 35% tax rate plus surcharge and cess will apply. So there is
Right,
no
sir.
tax rate defined. So in normal, the tax rate is generally defined for interest, dividend, your capital gains. If it is related to those securities and long-term capital gain, which is 12.5%, or 20% in case of other things, right? Similarly, in case of fee for technical services, royalties, 20% is defined. For all other incomes, business incomes, other incomes which are not specifically mentioned, they are always taxed at the normal tax rate, and in case of individuals, at the maximum marginal tax rate. So the TDS will also be the same, right?
Right, sir.
Okay. Now, business connection here, they have mentioned shall include business activities carried out in India in case of which all or any part of operations are carried out in India or significant economic presence. So now, which this is much more streamlined and structured because earlier business connection was very haphazardly defined and it was just mentioned business connection shall include. It was not there like this, and simply just said in respect of any asset being shares. The earlier definition was very, very cumbersome. It said that business connection from, just give me a moment. I'll let you know what it included. It was very, you know, generic kind of a definition. I'll just share my another screen just to showcase how it was there. Is my screen visible now?
Yes,
So
sir.
see,
Yes, Anshul.
you can have this comparison also. This comparison is provided in the Income Tax Act, in the on the Income Tax website itself. You can compare the sections. So you would see this is 2025 Act on the left hand side. On the left hand side, it is the old new Act, and this is the old Act, Income Tax Act 1961, amended by 2025 Finance Act. So you would see that how structured this is. Very well structured, streamlined in subsections. Whereas if you would read this, see how it goes. One, shall be deemed to accrue or arise in India. The first difference is incomes in subsection 2 to 8 shall be deemed to accrue or arise in India. Very clear. all incomes which are referred in 228 shall be deemed to accrue or arise in India. Why 228 only? Because 9 itself is a separate code. What does it say? 9, which is business connection. For the purposes of why business connection? Because business connection is covered here itself in 2. So any income arising from a business connection is going to be taxed. What does subsection 9 does is define what is business connection, right? So subsection 9 defines business connection. It says that business is carried on in India or significant presence, economic presence. Then it goes on to define what it shall include in business in A, which is this A. In clause A, business carried out in India shall include. What does it mean? Business carried out in India. This is business carried out in India. At the very subsequent clause, it says what is business carried out in India. Activity carried out through a person. This is basically provisions which are dealing with the dependent agent PE. This is corresponding to the dependent agent PE provisions which are provided in the DTAA and almost similar to what were provided in the old law also. So here it was mentioned, it was through explanation. First of all, there was no pointers. This was in the similar one sentence itself. Now they have pointed it out. They have given a list kind of a thing, which makes it more clearer. Then for the purposes of this clause, in case of business, other than businesses having business connection, all of which are not carried on in same in income in businesses deemed under this clause to accrue or arise shall be only such part of income as is reasonably attributable. So this was attribution clause which was there. No income shall be deemed to accrue through operation which are confined to purchase of goods. These were exclusions basically. Now, before defining what is included, they provided exclusions. So this was very, very kind of difficult to read. They have provided all the exclusions. In case of non-resident, being an individual who is not citizen or a firm or a partner who is not resident, no income shall be deemed to accrue or arise in India to such individual or firm from the operation which are confined to shooting of any cinematographic film. So what does it say? 5 clauses which have been provided of exclusion directly after the first clause. Now, what is this? What are included? They have provided it later on. Now, see, in the business connection, they were just starting with an explanation which said, who is basically it's the same provision. Who is habitually exercising in India, who is habitually exercises in India, and authority to conclude. Now, this was in an explanation. However, in the new act, it is under the clause B of subsection 9. So, if you would see, the provisions are actually same. There is hardly any difference. You would not see any difference in the provision, but they are much more structured. Now, what they say, first they have defined, then they will go on to give provisos, which will then say that what is included, what is not included. There is an independent broker or commission agent who is providing services in normal course of business. Those were excluded. Then again, an independent will also not be excluded if they are controlled or managed by the associated enterprises. What it means, provided that such business connection shall not include any business activity carried out through a broker, general commission agent having an independent status, if such broker, general commission agent is acting in ordinary course of business. Then what it said, ordinary course of business वगैरह को कैसे define किया, that where such broker, general commission agent works mainly, where such broker means an independent broker also, where such independent broker, general commission or other agent works mainly or wholly on behalf of non-resident or on behalf of such non-resident and other non-resident which are controlled by principal. Means if there is a group of non-resident which is being under the same management, then if you are working for that same group of associated enterprises of non-residents, even in those circumstances, he shall not be deemed to a broker of independent status. So means there were more passive language, more negative kind of inferences which were being drawn, that they will first provide that what is excluded, then they will provide what is exclusion from that exclusion itself. Then what it means, पहले बाहर ले गए, फिर उस बाहर ले गए वाले में से बाहर लेकर के आए, तो means then it comes back to the original provision. So that is how it was structured. If you would see in the new law, they just mentioned that a business shall include activity carried out by a person through a person acting on behalf of a non-resident. They've defined what all was there. Then a business activity carried out through person who is a broker through whom such activity is carried out and who is working mainly. So they have not excluded and excluded. What they have first defined it, what is included in the definition of business connection. What is included? That if a broker is acting on my behalf, then it is included. Who is working mainly and wholly on my behalf of non-resident, means I'm a non-resident, or such non-resident or other non-resident who are controlled. See how structured this is. Earlier, this was all provided in this one sentence. Now you would find it difficult how to read it, how not to read it, where what is connected to what. It is very structured. Such non-resident or other non-residents who first are controlled by such principal non-resident or have a controlling interest in the principal non-resident or are subject to the same common control as the principal non-resident. So it is very structured and streamlined. And such person shall not be deemed to having an independence. Means if a commission broker agent, if a broker, general commission agent or any other agent is satisfying these conditions, it shall not be deemed to be an independent status. First of all, it will be deemed to be an independent agent basically. Now what they say, first of all, this deeming provision has been provided. Then it says that in clause A and B, a business carried out in India shall not include business income or activity or operations of the non-resident carried out through a broker, general agent of an independent status if such broker, general commission agent or any other agent is acting in the ordinary course of business. Now what does it mean is that first of all, if there is an independent agent but who is satisfying all these conditions, shall be deemed not to have an independent status. First of all, वो independent status से बाहर चला गया, right? Once it has gone out of independent status, you will not come here. Clear? So you will come here only when you are not satisfying any of these conditions. So first, you are not working mainly or wholly. So when you are an independent party, you are not part of that enterprise, the group. You are neither controlled legally or economically by those enterprises for which you are carrying on business or for which you are undertaking these activities, right? So then in those circumstances, you will become an independent status. And also, first, you have to independent means you are working for other people. Then secondly, you have to act in the normal course of business also. Now, what does it mean is that, say, for example, I am working for other persons, but my predominant business is with one enterprise or group of enterprise being controlled by one party, one principal non-resident. And my 70 to 75% business is being driven by them. In those circumstances, probably legally, I can argue that my entire business is not with you. However, because my predominant transactions are with those group of enterprises, I may be influenced and I may take certain decisions or pricing decisions which are not in the ordinary course of business. And they are influenced, and I may decide to lower my prices just because there are certain other consideration or I am influenced because of the work I'm getting. So if there is anything to prove on documentation that my pricing is influenced, or if there is a substantial discount which I am giving other than the business or the commercial discounts which can be proved otherwise, or which can prove that I'm not acting in the ordinary course of business, in those situations also the foreign company will be deemed to have a business connection in India. Correct? So
Sir,
therefore, Mhm.
There are a couple of questions also.
Yes, please.
You want to elaborate further on this business connection,
Just
or
let
should?
me just have a few more words on this particular thing.
Or, all right, sir.
Now, what it may in the earlier provision provided that such business connection shall not be deemed to include or carried out through a broker, general commission. Now, what there is a significant significant move here. Earlier, what it was is that the activities of independent agent or any other agent were confined to these three clauses only. That if an independent agent or an independent person or a dependent agent, not an independent person, a dependent agent has to be undertaking any of these three activities only, right? Only then there will be a PE. So these two were interlinked because these were a proviso. These were provisos of this particular main clause only. So in these circumstances, there were a lot of cases which used to mention that, say for example, there is an agent, but neither I am exercising an authority to conclude, neither I am maintaining stocks, I'm just providing marketing services. In those circumstances, the argument was always there that because this agent, even though it is a dependent agent, is not engaging in any of these above three activities, then it will not create any business connection in India. However, if you would see there is a structural difference, now these are two different clauses. The activities of independent broker are not connected with the first clause. So even if the the dependent agent is carrying out any business activity, it says a business carried out in India shall include a business activity carried out through a person who is a broker, general commission agent, or any other agent through whom such activity is being carried out. So now there is a delinkage between these two. And the argument which we used to take in earlier days that even though there is a dependent agent, but if that dependent agent is not undertaking any of these three activities, then there is no business connection. And also, please mind it that as on date, the independence criteria is linked in the treaties to these three activities only. So in the treaty, you can still take a position that if an independent, if even if there is a dependent agent who is engaging in a business activity, but if that person is not doing any of these three activities, then there is no dependent agent PE. And once there is no dependent agent PE, there is no taxability of that non-resident entity in India. So there is a structural change in this particular provision in the new law because they have created two different clauses rather than this being a proviso to the original clause. So this was subservient to the original clause, whereas this now becomes an independent clause itself in the new law. So this is a structural change within the new law as compared to the original one. Now, please, should we go ahead and ask me the question?
Yes. Sir, one member is asking if a person receives legal services from non-resident for his business outside India. So a
Was business
person
outside India. Mhm.
is receiving legal services from non-resident for his business outside India.
Mhm.
Would this be income accruing outside India?
It can be considered, yes, because as I mentioned that there is a provision here in the fee for technical services, it says resident income payable by a resident except means what is excluded from the definition of FTS except where it is payable in respect of services utilized for a business or profession carried out on outside India. So this is very classical case of this particular exception. So what
Yes,
it
sir.
means, it gets excluded from the definition of FTS, then it will not become accruing or
Yes,
rising in
sir.
India. Correct?
Yes, sir. Correct. So there is another question from Arun Gargji. He's saying, sir, is there will be any liability of income tax in this transaction? Okay, so he's
Which
asking
transaction?
whether income tax will be payable. The
On which
transaction is
transaction?
between relative but does not fall relative definition as per Income Tax Act. Say Mr. X is NRI in USA and Mr. Vijay is in India. If Mr. A is NRI in USA is transferring $1 lakh in USA itself, maintain on an
Who
account
is
maintained
transferring?
by
Who is
Vijay.
transferring?
NRI is transferring
NRI is
in
transferring to whom?
USA itself by Vijay, who is a resident, but
No,
the account
is
belongs
Vijay
to
transferring?
USA. No,
Is Vijay gifting?
Vijay is not gifting.
Then who is gifting?
NRI is in USA and he's transferring in USA itself, but the account is maintained by Vijay in USA.
So
And later on,
if Vijay is a
transfer.
resident in India, see, if a Vijay is resident in India, his global income is taxable. So there is
Yes,
no concept of accruing or arising in India. So
correct.
even if Vijay receives money outside India, in India, wherever he receives it, it becomes taxable by virtue of global taxation.
Yes, sir. And he is asking later on that $1 lakh is getting transferred to India in his account. On this amount of say rupees 1 crore, $1 lakh becomes 1 crore. Is any tax liability that will arise to Vijay, like
See, first of
bringing
all,
income back into India?
that, that's what I'm saying. So the tax liability does not depend upon whether that income is being brought in India or not. First of all, we have to see the residential status of Vijay. So if Vijay is an ROR, resident and ordinarily resident, then that person's global income is taxable in India, right? Once that global income is taxable, then wherever it is received, it does not matter. Whether it is first received in USA or in India, it does not matter. What we have to see is whether that NRI person is qualifying as a relative under the terms of definition provided in the Income Tax Act or not. If that NRI is within the definition of relative, then no taxability. Whether you keep
But
it there, whether you
when
bring
he
it
is
here,
bringing that income back to
that
India,
does not, no. So bringing of money within India does not trigger a tax liability. It
right?
is the first receipt of that money from the source, which is the trigger point of tax liability. So
Correct.
once it has become my property, that money has become my property. At that point of time, it triggers the taxability. Once it becomes my property and I am transferring that back to India, it is just a normal remittance of funds back to India. Nothing triggers a tax liability.
Right, sir. So there's another question from Chandresh, sir. Query is if holding company in India and subsidiary is in Singapore.
Holding
And
company is in India and subsidiary in Singapore. Okay.
okay. And many steps subsidiaries in other countries consolidated in holding company will be taxable in India.
No, no, no. Taxability only arises on the standalone financials. So even if of Companies Act provisions, you are just consolidating the books of accounts and preparing consolidated financial statements, that does not trigger tax liabilities in India. Until and unless the profits are repatriated either in the form of FTS, interest, or dividends, that does not make any profits liable to tax in India just merely because on the basis of consolidation of books of accounts. Also, you should be mindful that the income tax returns should be filed and the computation of income should be prepared only on the basis of standalone financials, not on the basis of consolidated. And also, the reporting in the income tax return forms should be of the standalone financials, not of the consolidated figures.
So he is going on to explaining his point of view. He's saying, according to me, yes, holding income is taxed as it is resident company, along with DTA playing it effect to avoid dual taxation. And he
Mhm.
is also saying we have only console the financial for reporting purpose of ROC, not derived any income in India, and also filing income tax on standalone. So he's saying yes, we are filing on standalone.
Mhm.
Whatever you were explaining, only is explaining. So uh, So as per sir, the answer is no. There will be no tax in India.
Right.
So another query from CA Mohammed Imran. If Mr. A is not resident in India, in a tax year, and in employment in a company in India,
Mm-hmm.
and is outside India for a project of Indian company outside India,
Mm.
is his salary taxable in India?
No. If that person is not non-resident, if that person is a non-resident, services are rendered outside of India, then that income does not become taxable only by virtue of an employment with the Indian company.
Right, sir.
Any income falling under head salaries shall be deemed to accrue or arise in India if it is earned in India and any income payable for services rendered in India. First and foremost condition is the services is rendered in India. The only
Right, sir.
condition of taxability wherever the services are being rendered only arises in where the payer is government. As I explained in terms of embassies or other undertakings, wherever the employment is with government of India and income is being paid to an Indian citizen, then it does not matter where you have rendered the services. Wherever in the world you are rendering the services, that will become taxable in India. However, for a normal company or even for a government undertaking, the PSUs companies, they are not government. Say ONGC, Oil India, and all those companies under PSUs, they are normal Indian companies. So in those circumstances, they keep on sending people on projects situated
Right,
outside
sir.
of India, oil rigs. So wherever you are rendering services, that's the location where it will be taxed.
Why have they made such a distinction? Like if a private company is doing the same thing, no tax. But if your government is doing, then there is tax.
Government, because see, it's government, not government company. Why government? Because generally the employees of government are taxed under the international tax laws itself by the government, which is paying that income. Because most of the times, government will depute people only on embassies. Most of the times, there are a lot of foreign embassies, foreign high commissions which are there. And if you read UN conventions, these embassies are generally treated as foreign jurisdiction for tax purposes. Also, for administrative purposes, most of the local jurisdictions don't have applicability of their local laws within those premises of the embassies, right? You would see that even if a foreign diplomat does a crime in India, even they are immune from any kind of legal proceedings within India. So similarly, the tax jurisdiction also resides with the the home jurisdiction, the
Right,
government
sir.
which is making the payment,
Correct.
right?
Is there any definition for government under this act? Government
I
has been
don't think
defined
so.
in new act,
I don't think so. Government is very generic thing. I don't
and
think that it is defined.
so PSU will not fall under government,
No, no, no. PSA will not
obviously.
fall under government.
Yes, state government will fall under this definition.
State
Uh,
government, yes, it may, but generally, you will not find any state government deputing people outside of India.
right. So there is one last question, sir. If an NRI, so there is a non-resident Indian, receives Social Security Fund balance like EPF in India in
From
his
outside of
US
India.
account, Social Security Fund like EFPF in his US account,
Mhm.
and then transfers to Indian account. Will it be taxable when he transfers to Indian account?
See, there are multiple views around this. One view says that because the services were rendered outside of India, because most of the time this social security contribution would have accrued when the person was based outside of India, right? So till the time that person was based outside of India and those accruals have happened during that time period, that remains untaxable. And once that person has moved to India and has become a resident, ROR, not RNOR, till the time that person is an RNOR, the accruals till that point of time stay non-taxable because they have accrued outside of India. But once if that person becomes a resident, from that period onwards, the accruals also start getting taxable because then global income becomes taxable, right? So even if that amount was not withdrawn, those accruals for that time period will become taxable in India, right? Because
Oh, but in his
for
case, he's still an NRI. He is
he's
not
still an
making
NRI.
it. Yeah,
No, no, no.
he
In
is
that
not
won't be the case.
making him a resident, ordinary
So if
resident
that
or
person is all
resident,
an NRI, then there is no question at all for taxability in India. Why it will become taxable? So services were
because he's
rendered outside of.
transferring to India, no? After
And again,
receiving
then see again, then the principle which I explained earlier.
repatriation is happening.
Repatriation is not the trigger point for taxation. It is the first receipt. Now, the actual problem arises when that person was situated outside India, based outside India, when the services being were provided, that person did not withdraw, or the laws of that country did not allow to withdraw before a particular age.
Well,
Say a person worked in that country till the age of 50, the money could be withdrawn after the age of 60. For 10 years, that person is now based in India. For that 10 years, there were accruals which were happening. Accruals means there was interest income or any kind of accrual which was there in the social security account. Now, the time period, there are two views applicable on that. One view is saying that now because he is a resident and now he's drawing entire money when this person is a resident,
that's not.
then the
You are
entire amount become
you
taxable.
are making the person as resident. See, a
I
person
yes,
remained outside India. He did
that
not
I've
come to
explained.
India.
No,
Ha,
no, that
so
I've
mm,
explained.
so
There
don't
is,
confuse. Don't make him a resident.
I am explaining one more scenario to you, which is
Okay,
extension of the question which you have asked.
okay,
That in a scenario when the person comes back to India,
correct.
right? And in that
Hmm.
situation, that person becomes a resident, but the social security, because this is more complicated. So the
Yes,
audience
yes.
must be aware about the situations in this kind of circumstance. When a person has moved back to India and
Mhm.
has now become a resident, and the maturity of the social security contribution happens now when he is an ROR. At that point of time, the first credit also happens when that person is a resident. In those circumstances, there are two views. One view says that till the time he was a non-resident, all the accruals and all the contributions which were made is not taxable till that point of time. And once he had become a resident, the accruals after that time period becomes taxable. The other view, which is more conservative and which is more in the favor of government, says that now because he is a resident, then all the accruals which have now become due to him because of the maturity is now taxable in India because at this point of time of maturity, he is a resident and ordinarily resident. So most of the SACs generally take the view which is more aggressive, which says that because I had rendered services outside of India, till that time period, it should not be taxable. And that has been
Yes,
accepted by the judiciary in certain cases also,
right, sir. Thank you.
right?
One person is saying,
Let me just
so
conclude the provisions. Let me just go through in 5 minutes
thank
because there
you.
are certain
So in
provisions.
that case, it should be taxable.
Shruti, just
Okay.
let me just conclude
Yes,
a
sir.
few of the
Yes,
The
provisions.
so
questions are
that will be
over.
better. Let complete the topic because already
Ha.
6 o'clock. Sure.
Yes, yes. So in 5 minutes, I'll just conclude.
Yes.
So in this significant economic presence, because this is very, very critical, I'll just mention that the significant economic presence earlier it was provided by way of explanation 2A. Now it forms part of definition of business connection itself. Here, business connection clauses are there in business connection 9, A, B, C, D. Now D says non-resident shall be deemed to have a significant economic presence in India where there is transaction in respect of goods, services, property, including provision of download of data software if aggregate payments exceed certain prescribed amount, which is prescribed amount is 2 crore rupees. So now this is a direct outcome of the web section plan, which was related to digital economy, and which was provided, or an action plan which was provided to deal with the digital economy, wherein the services are being provided over internet, and the traditional provisions of business connection or permanent establishment in the DTAAs did not capture the taxability of certain these services provided over the internet. So in that provision, it was mentioned that the local income tax laws may be amended to tax such kind of payments. And one of the implication was levy of equalization levy, which has now been removed. And the other outcome was bringing in that this provision of significant economic presence. However, Indian government has played smartly, and they have provided a very broad definition of significant economic presence, where they have included everything: provision of goods, services, property carried on by a non-resident with any person in India, including provision of download of data. So this is only an inclusive part, but the overall part is a very, very generic, broad. Say, for example, if I am an Indian company, I am importing machinery for my setting up of my plant, which is more than 2 crore rupees. Then that payment in lieu of purchase of machinery becomes taxable in India, because this non-resident will be considered to have a significant economic presence. Now it becomes taxable in India as per the income tax law. So therefore, you have to take recourse under the DTAA to say that that foreign company or non-resident party does not have a permanent establishment in India. And in those circumstances, to claim the benefit of DTAA, you need TRC, you need that foreign company to file a Form 10F, and you need a non-PE declaration. Now, why this becomes important is because for payment of goods, payment of money for goods does not require filing of Form 15 CACB. Generally, bank don't ask for it. And in those circumstances, the Indian payers are not even aware that in purchase of these goods. So say, for example, if you are purchasing raw materials, your entire raw material is sourced from outside of India, and there are huge payments being made. So why are you sitting at a risk? Because you have not deducted TDS on these payments. When you are not deducting TDS on payments made to non-resident, 100% of that amount can be disallowed, right? In resident non-deduction, the 30% amount is disallowed. Whereas in case of non-deduction of TDS, in case of non-resident parties, 100% of tax is disallowed. So you are sitting on two exposures. One, the TDS amount will be recovered from you. Second, your entire amount will be disallowed under the normal income tax provisions. So therefore, it is very, very important. Significant economic presence, although the definition is almost similar, there is no change. However, it is more structured, and the conceptual terms, and on the conceptual terms, you should be aware that wherever there is any supply of goods or services or property by a non-resident in normal business circumstances where you are not submitting any Form 15 CACB, you should be aware, and you should please take into consideration while you are doing the tax audits. Because in tax audit, there is a liability on tax auditor to verify whether the TDS has been deducted properly or not. So, right? And also, there was a confusion that if foreign companies only purchasing goods from India, then there is an exclusion from business connection definition. See, purchase of goods is always there. So this has always been there in the old law, that if the foreign company is only engaging in purchase of goods for export of outside of India, then this is not considered as business connection. This is excluded. Business connection shall not include any business activity if carried out through business of broker of independent status, or which are confined to export of goods, collection of news, display of uncut diamonds, and cinematography films. So first and foremost was purchase of goods. Now there was confusion in the old law, which said that this purchase of goods exclusion only applies to business connection and not to significant economic presence, because in this significant economic presence, the proviso was not there. So they inserted this proviso specifically where transactions were provided further, that where the transactions or activities are confined to purchase of goods. So there was a confusion that purchase of goods will also qualify as significant economic presence. Means purchase of goods means a non-resident party is only purchasing goods from India and supplying to their foreign locations. So even that purchase was being considered by some tax officers to be tax liability of the foreign company, creating a tax liability on the foreign company. Say, for example, there are a lot of procurement hubs, companies who are just procuring goods for their clients from India. In those circumstances, these companies were creating significant economic presence, right? So now they have clarified and they have made it part of this main section itself. Where is it? Yes. The provision of D shall not apply to transactions which are confined to purchase of goods of export for purpose of export. Now, this exclusion is for purchase of goods, not for purchase of services. So they have not mentioned purchase of goods or services for export outside of India. So what does it mean? All these GCCs, which is the Global Capability Centers, these are providing captive services to their parent companies. They are providing services. Now the foreign parent company is actually setting up a GCC in India, a third party, carrying out activities. Now a non-resident company, parent company, where there is a transaction, foreign company is having a transaction for any services, means the Indian captive service provider is providing services, and which is exceeding 2 crore rupees. Now, Indian GCC are big GCCs, they will have, say, for example, costs of 100 crore, 200 crore, and they are putting up a margin and receiving money. Now, that foreign parent company can be considered to have a significant economic presence in India. And because of the GCC, if they are earning certain income from India or they are providing they are getting certain other benefits in outside of India, Indian tax authorities can say that you have a significant economic presence and you become tax liability because the exclusion which is being provided is only for goods, not for services. Now, certain case laws, again, interpretational issues, have mentioned that goods include services, but the new law has failed to specify and clarify that particular position. So, this is what is significant economic presence is. Then there are certain other provisions for indirect transfers. The provisions are similar in subsection 2. This is the entire so the foreign company has direct control over the intermediary company. Say US company holding Mauritius, Mauritius holding India. US company transfers Mauritius company. So the Mauritius company had direct shares in India, right? So therefore, this becomes one layer only, indirect transfer. Now, this particular third clause says US company holding Netherlands, Netherlands holding Mauritius, and Mauritius holding India. And if US company transfers Netherlands, it may be argued that Netherlands does not have any shares which are situated in India. So then it says that either directly or indirectly, if such company, now Netherlands company owns indirectly the shares situated in India, assets situated in India. So this takes care, the third clause takes care of the multiple layers in the structure, in the holding company structures, right? So there are certain exclusions provided for fund managers, which was also provided in earlier law, that there are certain fund managers who are investing in India, and they are sitting in India also. So they were uh, to boost the capital markets in India. There were certain exclusions provided to them that just because they are having some office or a fund manager sitting in India, that will not create a business connection in India. So these are also provided here. And there are certain provisions for IFSCs, International Financial Services. So this is it from my side. I hope that this is much better and structured and easy to read law from now on. And hopefully there will be much more lesser litigation in Income Tax Act. So thank you very much all. I'll be happy to take queries later on probably. The presentation which I'll be sharing will have my email ID. So you can reach out to me anytime. Thank you. Thanks a lot, Shruti. Over to you.
Thank you, sir, for a wonderful deliberation. The clarity that you brought about in the new Act, Income Tax 2025, really made it very easy for every professional to grasp the new Act and also to understand the old queries that were prevailing. So we were expecting a Master Blaster performance, and it's a six again. So
Thank
so
you.
it's a
Thanks a lot.
century. And there are particular one or two queries pending. I will request the members to post them on sir's email ID. For a couple of days, he'll oblige us by entertaining some queries which have been left over.
Yes, Shruti, that will be the
Okay.
better. And Anshul sir,
Thank you.
wonderful session, I would say only. And
Thank you, sir. Thank you.
great learning. Asha ji, are you there? No, Asha is not here. So with this, I would like to end today's session. This is the third session on this new income tax 2025, where many members have learned and so much discussion. Now, tomorrow, fourth session scheduled on capital gain intricacies by Advocate CA Pankaj Ravgi ji. So, definitely, Anshul sir, please share your presentation to me as well. So, I will
Ah, sure,
share
sure.
the
Asha ji is
participant.
there. I think Asha ji just replied to one message.
Yes, it's now. Acha, okay. Yes, now she can reply.
Hey,
Yeah.
Sumit ji, I'm traveling
Okay,
basically.
okay. No, no problem, no problem, no problem.
Uh,
So you are listening to that, that is required during the traveling also. So wonderful discussion. आर के गुप्ता सर is also here since starting 4 बजे से पहले से वो ज्वाइन किए हुए हैं. मैं उनका भी धन्यवाद देना चाहूंगा. सर फाइनली मैं रिक्वेस्ट करूंगा आप ही से कि फॉर्मल वोट ऑफ थैंक्स के लिए गुप्ता सर.
Well, Sumit it was an excellent session.
Yes, sir.
And the icing on the cake was that the speaker explained the rationale also behind each and every subsection, the thought which was going in the mind of the litigants and the revenue. So he explained both sides. So that was the perfect deliberation. Thank you so much for organizing such sessions and inviting such excellent speakers.
Thank you, Anshul sir,
Thank you.
once again to you,
Thank
and
you, sir.
thanks to
Thank
all
you so much.
participants. Tomorrow, once again, we are joining this fourth session. Thank you very much, sir. Thank you. Thank you.
Thank you. Thank you.
Thanks to
Have a
all.
good day. Bye.